tomorrow. I tend to think it's going to be in line with expectations, although I might be surprised. I think the more interesting question is what does the Fed do? And I think their game plan. You know how some coaches they come into a football game with the first 20 plays already kind of pre-scripted. I think the next two meetings are pre-scripted. I do think they're doing another 25 basis points hikes, and I think they pause the next time. And here's why. And my reasoning is completely different. It has nothing to do with the macroeconomics or inflation. I think there's a bigger game here being played. You have to understand that the banking crisis, although is now off the headlines and the news cycle kind of moved on, the banking crisis is not over. In fact, it's been marinating, and it is still very much there because the underlying factors of the banking crisis are still very much intact. Just to keep it simple, and I'll tell you how it has to do with the Fed, because it seems like it unrelated, but it does. The banking crisis started off when the Fed started raising rates very quickly. It sent a lot of people taking their money out of the deposits into the money market. You know, why take a half a percentage point when you can get four or five, pretty much with very similar risk with treasuries? And the banks were suffering bleeding from their deposits for the better duration of the year with before SVB's collapse. The problem with SVB is that it highlighted the the underlying simmering situation, because what happened with SVB is that everybody knows now the story, right? But their deposits were all basically, I would call them non-sticky deposits. It's essentially working capital from startups who were burning a lot of cash, and when they fell through, obviously a lot of mismanagement issues by Greg Becker were brought into light, but also there's a structural problem that came into light, and that structural problem is $1.7 trillion of unrealized losses, which the entire U.S. banking system is sitting on, which is primarily caused by the Federal Reserve. Because if you go back in history and you look, you'll find out that in March 2020, that date should be very clear to you what it means. In March 2020, we basically said to the banks, hey, you don't have to hold any reserves at this point. And basically, the banks emptied out the stables. So the banks were very low liquidity. If you compare US banks to European banks, you see a huge difference. I highlighted a few in the tweet a few weeks ago, but I'm not even talking about the best European banks. They're in the teens and upwards. So very few banks in the US are above 10%. And what ended up happening is, as the Fed raised rates, the bonds that these banks were sitting on became very, very undervalued in the open market. And of course, everybody reclassified everything as held to maturity to avoid reporting these 1.7 trillions of losses. SVB came into light and highlighted the situation. Now, at this point, the bank run is over. The psychological pressure that we had seems to be over, but we're just one spark away from another potential bank run on numerous smaller regional banks. Not talking about the big banks, but small regional banks are basically in the same situation they were a couple of weeks ago. That is, that they're sitting on a pile of bonds that are now market priced a lot lower than their cost basis. And if they need to raise capital and generate liquidity fast, is going to start a potentially SVB 2.0, because people freak out when they see you sell your stuff at half price. If I see a company selling its assets at half price, it basically tells me there's a problem. And a lot of these banks, they don't have the financial stability or backing like the big four banks, and they're definitely in trouble. The only way to allow these banks, that's why the Fed won't raise the threshold, the reserves to 10% back, because that will essentially be that problem. The only way to save the regional banking system in the US is for the Fed to essentially slowly but surely start to reduce rates. The
Hey,
reduction in
Tom.
rates, yes.
Tom, I'm sorry to interrupt. I've been told to review some breaking news, and some of it is
Go ahead.
obviously relevant to what you're speaking. Now, listen, I personally believe that having four Fed speakers in a week and however many we get each additional week is a bit of a dog and pony show, and it's complete nonsense and reduces confidence in the market. But we do feel compelled to at least review what they're saying. And the Fed's Williams just had quite a few statements. here. I'm going to just get a very quick synopsis and then we'll pivot. I'm seeing some slowing down in labor demand. The labor market is still very strong. Inflation is still way above our 2% goal, but I'm seeing it coming down mostly in goods and commodities. So listen, just to give you guys the quick takes, I believe CPI is going to come in obviously lower than 6% tomorrow. We're already seeing language across the Fed that they're expecting that and that they're going to be data driven, which he says here as well. Some core services inflation, example, housing hasn't budged yet, so we have our work cut out for us. It's too soon to see changes in credit conditions and availability. We're not seeing strong signs of those effects happening yet. So he says the credit impact from the bank turmoil is still uncertain. We've gotten policy to a restrictive stance. We now need to watch the data on retail sales, CPI, and others. We are somewhat restrictive on policy. He goes on to say that if inflation becomes more persistent, they'll need to adjust policy. Bank failures have added to uncertainty in the outlook. We desperately need to see underlying inflation fall, which I think they're expecting, and that there's an expectation that we will see the economy grow at a modest rate this year. Basically, the synopsis of what he's saying, balance sheet reduction is proceeding as expected. Following recent stresses, the banking system has truly stabilized. To me, it seems like the Fed right now believes that they're doing the right thing, that it's probably time to pause in the very near future, and obviously sort of talking their own book and excited about what they've accomplished. I think that most of us here I think the Fed is kind of a joke and has, okay, I'll speak for myself, and has mismanaged this massively. I think they overshot heavily, obviously, on the downside with easing, and now we're going to and have already overshot and should likely pause. I mean, I'm sure there's quite a few people here who have either varying or agreed opinions on about what the Fed has done, but they almost are admitting here that they're working with lagging data. And we know that the leading data, if CPI is continuing to come down and then inflation is coming down, I don't see any reason why it would continue to hike right into a recession, an unprecedented move. But hey, this is the Fed we're talking about. And like I said, they miss every time.
Yeah, I'm pretty convinced that the Fed is, if the Fed pauses tomorrow, that will be incredibly unexpected. I think they've choreographed a 25 basis point increase. If CPI comes in, like you said, possibly cold, I'm actually thinking that the CPI will come in hot. And I think that it will justify their 25 basis point hike. And I think that if the CPI comes in either as expected or hotter than expected, they're going to hike 25 basis points. And, we've all seen gas prices go up. So it's just very confusing about what the data is going to look like. I don't think the data actually, I mean, are you saying, Scott, that the data may not matter, that they've already made their decisions?
Well, I think in general, they've probably already made their decisions. I think they already know the data, let's be real, right?
Yeah.
They're not waiting. It's not like they're waiting. And I think that we've seen some creative accounting with the way that CPI is calculated over the last year and a half to fit narrative. So to your point, I mean, perhaps they're just looking for a way to justify 0.25, but then say, hey, we've got this under control. We can pause for the rest of the year. What I would be very surprised about, which was seemingly priced in at the last hike, was a lot of people believe there's going to be a pivot and then a major loosening over the rest of the year. I do not necessarily see that happening. I don't see a pivot to going back the other direction, but I do think they're going to pause and wait. And honestly, they should, and they already should have a few meetings ago, in my opinion, because we all know that it's extremely they're operating on extremely lagging data, and the hikes of 6 months ago are just starting to play out now. So to pretend that they should be hiking now to affect the economy in 6 months seems nonsensical to me.
Yeah, what's really sad is it feels like it's more about Powell's legacy as like Volcker 2.0 than it is about what's doing the right thing. I mean,
yeah, but Volcker tightened into when debt to GDP was 32 or between 23 and 32%. We have Powell hiking when debt to GDP is 123 to 132%. So I think it goes back.
And I think you guys are highlighting.
Point. Yeah.
Yeah, you guys are highlighting a key factor there where we're in a fiscal dominance regime, specifically after, let's say, the S&L crisis and Volcker's reactions within the interest rates, right? And if we go back to the Glass-Steagall Act of 1933 that set banking precedences and FDIC insurances, it was repealed back in 1999 after Clinton decided to bring in the Financial Service Modernization Act. And this is a key point because a lot of deregulation within, let's say, Greenspan Greenspan era was attributed to this form of act, and it allowed a form of proponents within, let's say, even the Boskin Commission of 1995 and how they utilized gauge theory in order to recalculate the CPI in accumulations to a roughly $1 trillion profit with the Harvard alumni and Stanford developments, which was essentially a beneficial treasury development in that sense, because they were able to, within new inflationary metrics, retain a formal capital within their actual treasuries. But to jump it into today, I think it creates a new precedence that since these time periods, we live in a fiscal dominance regime where Fed has very limited ability since the 2010 Pay-As-You-Go Act to interact within, let's say, fiscal expenditures. And then since now, we see a low rate environment shifting into a high rate environment. And so the precedence is essentially this search for yield and how that affects the current market participants. And we're seeing a lot of inflows towards money market funds in that sense. And this is where it becomes a interesting relation to calculate the actual deposit betas in relations to the outflows of banking institution into other forms of, let's say, liquid markets in that sense.
Yeah, will be interesting. Amy, would love to get your thoughts. Thanks for joining us. Would love to get. We were talking about real estate earlier, and I really want to go into this because this affects, to me, consumer sentiment more than any other space. Because people are, right now, people got homes at really low interest rates, and for people that have Airbnb, short-term rentals, long-term rentals, commercial real estate across the board, what is the sentiment within the industry? We saw the business sentiment come out, but would love to get thoughts on. What is the sentiment in the industry? What are you guys doing to prepare for additional hikes or a potential pause or cuts? I don't know. It feels this is the highest uncertainty that we have, despite, by the way, the VIX being decreasing today. It's kind of fascinating. Amy, would love to get your thoughts.
Yeah, thank you. This is a really, really tough real estate market. And